HIMS and HERS was one of the hottest telehealth stocks on Wall Street. A 50% drop in weeks, a patent lawsuit from Novo Nordisk, an FDA crackdown, and a Department of Justice referral. This is the story of how a $2 billion telehealth empire bet big on weight loss and now faces an existential crisis. I am going to break down what happened, what it means for the stock, and whether HIMS is a buy, a hold, or something you should avoid entirely. Let us get into it. Before we talk about the controversy, let us understand what HIMS and HERS actually is. Founded in 2017, it is a direct-to-consumer telehealth platform. They connect patients with licensed providers for treatments in hair loss, erectile dysfunction, skin care, mental health, and, more recently, weight management. The business model is subscription-based. You sign up, consult a provider online, and get your treatment shipped to your door. As of their most recent quarter, they had nearly 2.5 million subscribers, revenue approaching $600 million per quarter, growing nearly 50% year over year. That is real scale. Gross margins hover around 75%. They carry zero debt, and they recently turned profitable. On paper, this looks like a telehealth winner. Here is where the story gets interesting. In May 2024, HIMS started offering compounded GLP-1 injections, essentially cheaper alternatives to Ozempic and Wegovy. They were able to do this because of a legal loophole. When the FDA declares a drug shortage, compounding pharmacies are legally allowed to produce alternative versions. Semaglutide, the active ingredient in Ozempic and Wegovy, was on the FDA shortage list, and HIMS took full advantage. By 2025, weight loss offerings were projected to generate roughly $725 million in revenue, about 30% of the company total sales. Think about that. Nearly a third of the business became dependent on selling compounded versions of another company's patented drug. That is a bold strategy, but it comes with enormous risk.
Here's where it gets even more complicated. In April 2025, Novo Nordisk and HIMS actually partnered. They announced a collaboration to make obesity care more accessible and affordable. It seemed like a win-win. But just 2 months later, in June 2025, Novo terminated the deal. They accused HIMS of illegally mass-producing compounded semaglutide under the false pretense of personalization. In other words, HIMS was supposed to be making individually customized treatments. Novo claimed they were running what was essentially a factory producing copycat drugs at scale. That partnership collapse was the first domino. Then came the move that set everything on fire. On February 5, 2026, HIMS announced a compounded oral semaglutide pill, a direct competitor to Novo Nordisk's FDA-approved Wegovy pill, which launched in January at $149 a month. The HIMS version? $49 for the first month, $99 after that. This wasn't subtle. This was a direct challenge to one of the most powerful pharmaceutical companies in the world, selling a knockoff version of their blockbuster drug at a fraction of the price. The reaction was swift and brutal.
Within days, the FDA announced it would take what they called decisive steps against non-FDA-approved compounded GLP-1 drugs. They specifically targeted products mass-marketed as alternatives to approved medications. The message was clear. HIMS was in the crosshairs. Then the Department of Health and Human Services referred HIMS to the Department of Justice for investigation. We're talking about potential federal violations of the Food, Drug, and Cosmetic Act. This isn't a slap on the wrist. This is the federal government signaling that they view what HIMS did as potentially criminal. 2 days after the pill announcement, HIMS pulled the product entirely.
On February 9, 2026, Novo Nordisk filed a patent infringement lawsuit against HIMS in the U.S. District Court of Delaware. The suit centers on U.S. patent number 8,129,343, covering all compounded semaglutide products HIMS has sold, including injectables and the now withdrawn pill. Novo is alleging willful infringement, meaning they believe HIMS knew it was infringing and did it anyway. If the court agrees, HIMS faces enhanced damages, which could mean triple the normal award. Novo sent a demand letter on February 8, 1 day before filing. HIMS kept selling. That timing will be critical in establishing willfulness. Let's talk about why this could be devastating for the stock. First, revenue concentration. Roughly 30% of revenue came from weight loss products, most of which were compounded GLP-1s. That revenue stream is essentially gone. Second, legal liability. If Novo wins the willful infringement case, we're talking about potentially billions in damages. Third, the DOJ investigation adds criminal risk on top of civil liability. That's a completely different level of threat. Fourth, the competitive landscape has shifted. Both Novo Nordisk and Eli Lilly now offer discounted branded GLP-1s through the government's Trump Rx program. Wegovy pills at $149 a month. That undercuts the entire value proposition of compounded alternatives. And fifth, the stock. HIMS went from $68 a share in February 2025 to about $17 today. That's a 75% decline. Investors who bought at the highs are sitting on massive losses, and the uncertainty isn't close to being resolved. Now here's the other side. The bull case is actually compelling if you can look past the noise. First, the core business is strong. Remove the GLP-1 controversy entirely, and you still have a fast-growing telehealth platform with 2.5 million subscribers, 75% gross margins, zero debt, and profitability. Hair loss, sexual health, skincare, and mental health are recurring, high-margin categories that aren't going anywhere. Second, the stock is priced for disaster. At $17, you're getting a company doing nearly $2.5 billion in annual revenue at a significant discount. Analysts still have an average price target of $38, implying over 100% upside. Third, the legal overhang may be manageable. HIMS already pulled the compounded products. A settlement with Novo is possible and could remove the uncertainty relatively quickly. Fourth, weight loss isn't dead for HIMS. They can pivot to non-semaglutide weight management solutions, liraglutide-based products, lifestyle programs, or FDA-approved generics when they become available. Let's look at the numbers from Stock Fortress. Revenue growth has been exceptional, 49% year-over-year in the most recent quarter, reaching nearly $600 million. Full-year 2025 guidance was $2.33 to $2.35 billion. The company is generating positive free cash flow with improving operating margins, now around 6% and projected to reach nearly 14%. Earnings per share came in at 6 cents last quarter, slightly below estimates of 9 cents. That's a miss, but the company is still in its early profitability phase.
So, what's HIMS worth? At the current price of around $17, the market cap sits at roughly $3.8 billion. For a company doing $2.5 billion in revenue with 75% gross margins and improving profitability, that's not expensive. Based on consensus estimates, the stock trades at about 1.5 times forward revenue. Compare that to peers in telehealth and high-growth health tech, trading at 4 to 8 times revenue. If HIMS can weather the legal storm and maintain its core business growth of around 30%, a return to $30 to $40 per share is entirely reasonable by late 2027. But, and this is a big but, if the lawsuit results in massive damages, or if the DOJ investigation leads to enforcement action, the downside could be severe.
Let's talk competitive landscape. In telehealth, HIMS competes with Teladoc, Ro, and Noom, among others. Their advantage has been brand recognition and ease of use. They've built a consumer brand that resonates, especially with younger demographics. The subscription model creates switching costs, and their vertical integration gives them margin advantages. But here's the moat question. Without GLP-1s, what differentiates HIMS from other telehealth platforms? The answer is their direct-to-consumer distribution, their brand, and their scale. 2.5 million subscribers is meaningful. But they need to prove the business can grow without relying on controversial drug compounding. Let me lay out the key risks clearly. Number 1, litigation outcome. A loss in the Novo case with willful infringement findings could mean damages in the hundreds of millions or more. Number 2, DOJ investigation. Criminal charges would be unprecedented and devastating. Number 3, revenue gap. Losing 30% of revenue from GLP-1 products creates a hole that won't be easy to fill quickly. Number 4. Sentiment damage. The brand has taken a hit. Trust matters in healthcare, and being accused of selling knockoff drugs and facing federal investigation hurts. Number 5. Execution risk. Pivoting the weight loss business to legal alternatives takes time and investment, with no guarantee of success. So here's my take. I'd rate HIMS as a high-risk, high-reward watch right now. The core telehealth business is genuinely good. The growth numbers are real, the margins are excellent, and the balance sheet is clean. But the legal overhang is serious. You're betting that the Novo lawsuit settles for a manageable amount, the DOJ investigation doesn't escalate, and the company successfully pivots its weight loss strategy. If all three of those go right, buying at $17 could look brilliant in hindsight. If any of them go wrong, there's meaningful downside from here. My approach? I'd wait for clarity on at least one of these catalysts before committing capital. The upcoming earnings on February 23 could provide that clarity. If management guides confidently on non-GLP-1 growth and provides updates on the legal situation, that could be the entry signal. That's the full breakdown on HIMS, the Novo Nordisk lawsuit, the FDA crackdown, and what it means for investors. Whether you're bullish or bearish, the key is making informed decisions with real data. Head to stockfortress.com to run your own free analysis on HIMS or any stock. Get the financials, the risks, the valuation, everything you need to invest with confidence. Stock Fortress, invest smarter.